Welcome to the coffee shop, everybody. This is your host and barista, and I'm here to give you some information that is key for you people who really want to learn how to use price action and moving averages. This requires very few indicators. You don't need any special moving averages. You don't need any with flags and signals and alerts and all this other stuff. It is simply moving averages. So if you want to learn the basics of how to use my moving averages, this is the video for you. A comprehensive approach to using moving averages. This is part one. There is so much going on in this length of time that just the moving averages are telling me, okay? I want to tell you about all of this stuff, but I can't do it in one video, so this is going to be 4 videos. And today, we're going to be talking about the bullish consolidation zone, right? The bullish consolidation, and how moving averages tell you when it's happening, okay? Also, this consolidation, it's important for what happens later, like in the future. So moving averages are doing something now according to price action, and they are telling you the future. So if you want to learn the future, here you go. Let's get into today's video. We're talking about bullish consolidation. So what happens with consolidation? How does it get there? Now, you can't just know that something is happening in the market. You need to know why it's happening, okay? Nothing happens for no reason. Candles don't close bullish just because they want to. Candles don't close bearish with a long wick just because they feel like it, right? They feel like having a tail today. That's not how it works, right? Something happened. A candle closes bullish because there were more buyers with larger orders than there were sellers with large orders, right? Now, you can have equal number of buyers and sellers, which you often do, but, you can have an equal number of buyers and sellers in a particular candle time frame, right? But the candle will close bullish because you have 100 buyers and 100 sellers, but the buyers are buying larger contracts or more contracts. So that is how that works out. Now, so moving averages, first let's talk about what they're doing, right? Moving averages, for you new people, are basically showing you the average of the closing price of candles over the last X candles. I'm using a 50 period moving average and a 100 period moving average, right? So at this point, my moving average is $61,107. That's the value of this moving average. That means if I take this point, where is that? There we go. If I take that point, okay, and I take all the last 50 candles and I average their price, this is the average price of the last 50 candles. That's what that is. So you need to understand that when you see moving averages, okay? So what you're seeing here is that the moving average is still rising, right? But the price is way up here, way far away from the moving average, okay? Now, why is this information important? You will know, trust me, this seems like the boring part, but it is very important, okay? Now, moving averages are showing you the average closing price. If your candles are closing above the moving average, it doesn't matter that they are bearish or bullish, just matters that the closing point of that candle is above the moving average. That means you are in a bullish trend. The further away you are closing from the moving average, the stronger your bullish trend is. Now, if you look at this right here, right, it starts moving up very sharply and then pulls down. Well, you can see here that the moving average did not really pull down anywhere. Why? Because this moving average is looking at 50 candles ago, but you are currently looking at the current candle. Why is this important? Okay, this closing price is closing above the average of the last 50 closing prices, which means there is a lot of force to keep this price way up here. So that means all the bulls are doing an above average. They're doing an above average job. Doesn't sound like much. It sounds like they're closing above average, and that may sound like it's an expensive thing to do. Not necessarily, right? Now think of it this way. What happens when you are closing bullish, right? when your moving average is bullish, right? But moving average is bullish, it's rising, but your closing price is below the average. That means the bulls are not doing an above average job, they're doing a below average job. That's where it gets important. So just because you're above it, that's only one part. You need to find out why you're below average and when you are below average. So that's a key thing to understand, okay? You have to take that into context and understand the bulls are trying to close above average, but they cannot do it. And you have to look at your chart and understand why is that happening, okay? So, and that's just one way to look at the moving average, right? And that's just one. So let's just get rid of this and put up a new one, and I want to show you what's happening here. So today we're talking about all the things that are happening in this chart, right? There's a lot of things happening here. I'm going to have to break this video up into 4 parts to show you about all 4 of the things that are taking place just in this short length of time. All of this takes place from February 28th all the way to February 29th. This is literally just one day, or like less than 12 hours is what's happening here. And all of this information shows up. So let's get into the bullish consolidation and what are you supposed to do with this? Now, consolidation means these always show up after there's had been a massive rally or a massive drop in price, okay? But in this case, you kind of had 2 of them, right? Let's see what's going on here. Everybody knows about the big drop in Bitcoin that took place a couple days ago or yesterday, right? So this big, this big drop took place, right? But this was after a nice long rally was taking place. Price comes down, comes up. You see how it's getting thinner and thinner, right? It's just kind of trying to find its center. And then it actually finds the center. It's finding the center between the last 20 and last 50 candles, or the last 20 and 50 closing prices. That gives you a bullish consolidation zone. Why am I calling it bullish as opposed to bearish? Okay, you have a 50 period moving average and a 100 period moving average. You don't have to use these 2 values. Use the values that you prefer to use for your trading strategy. Okay, so what happens here is that price comes down and it cannot maintain a closing value above or below either one of these, which means bulls cannot close above the average. They're closing below the current average, but they're closing above the long-term average, right? If this is 50 candles and this is 100 candles, what's happening here is that the candle cannot push against the last 50 averages, but it also can't be better than the most recent, it can't push beyond the last 100 averages, but it also can't break the last 50 averages. It's stuck somewhere in limbo in between. So this is a consolidation area. You can use these areas to accumulate trades, like accumulate positions. This is a bullish consolidation area because, right, the short-term moving average is above the long-term moving average. And you can see that once you make a new low and a new high, right, you have the new low after the downtrend and a new high, right? I'm calling this the last low because at this point you have the first, see there's a high and a higher high. You have the first higher high. So what I usually do with this is one of 2 things. Depending on how volatile the market is, okay, you can do 2 different things. You can avoid this area altogether. And that's one way that you can trade this. Do not trade it. The other thing that you can do here is you can find wait for the first higher high and then mark it. Look for the previous last low. Here's a low and a lower low, right? Do that. Trust me, just do this. Drag this out and just leave it dragged out. This is an area that you want to either break long or break short. And you have to do that by breaking a high that was made from that area. In other words, you need to make a low somewhere down here or a high somewhere up here. And when you break out of this zone, you need to break that low or the high, whichever one was made. Okay, and that will give you an indication of where you're supposed to go to next. Now, primarily, I want to break this zone going bullish because this is my current trend, my current moving average, right? And my long-term moving average. If you notice what's happening, I have a wick on the bottom, a wick on the bottom. I cannot get below the average 100. In other words, the bears cannot push down past this value. They can't get there. But we are able to get up and break above this right here, right? Able to do that and break this zone. So that's kind of triggering you to say, hey, I might be expecting a bullish breakout, okay? Don't look for divergences. Don't look for any of that stuff. Just watch for the breakout, okay? Just let the market play out whatever kind of highs and lows that it's going to do. So you got your zone, you get this one breakout, but after this breakout, when this takes place, you simply look for the high behind it. It's over here, right? This is the high behind the top of this box, right? There's the high. This price needs to break this high. It doesn't do it and it falls back down and it wicks below this. Now, you've got a couple of things going on here. When you made this move up and then came back down, you can consider this a resistance level. So draw a line, and that is the high that you need to break. Just drag it out, all right? Now, as you come back down, what I'm noticing is that this is clearly an uptrend, okay? For me, bearish candles make lows, bullish candles make highs, right? Bearish candles, let's do this here. Bullish candles are the only ones for me that make highs, and bearish candles are the ones that make lows, okay? So this will have a low, and this will have a high. That's all I see. So when I see a wick rejection of a long-term moving average, I'm only looking at the bearish candle. I don't care about this. It's a bullish candle. I'm looking at the bearish candle, right? Why is that? Think about it for a second. This already had some upwards momentum, a lot of upwards momentum. Even though it's a pin bar, it's fine. This had plenty of downwards momentum, and it was enough to keep it closed in a bearish position, but it still could not. This candle had more bearish move in it, and this one had more bearish move in it than this did. So I don't care about the low here against this 100 period moving average. I care about the lows on these two. So marking this out gives me the lows that would also need to break. So in case price would come back down through this low, I would start considering that I have to look for a new level in this box. Okay, so I'll do this. You end up breaking out, right? You broke out of the box again, and there's your swing high, right? You didn't get there. Went back inside. Now remember what I said. The candle, the one candle, is breaking against the average of 50 candles. This moving average is pushing down. This candle pushes up, and it still clears the box, and it clears this high, right? So you're able to break against the last 50 in the opposite direction. That is a strong move, okay? And that brings up myth number 2. I told you about myth number 1 that you don't need EMAs, right? For you new traders, you don't need EMAs. The myth number 2 is that you do not look for moving average crossovers. What you see here is no crossover, but you have a bullish move, right? It's not a moving average crossover. What you have is a price average crossover. So there has been this myth brought around that a moving average crossover is when moving averages cross over each other. Well, technically, logistically, that is true, but it doesn't mean that that is the trade setup, okay? A moving average crossover is actually when your price crosses your moving average, because one candle is able to break the value of the last 50 candles. That's why you need to know the importance of using a 50 or a 100 or a 20 or and what does it mean that you are breaking that average? One candle has enough force to break the average of 50, right? But one candle did not have enough force to break the average of 100. So you're not going to get short here, but you are going to get long here. You constantly have breaks above the 50. So your short-term trend, you are doing better than the average of your short-term trend. Remember what I said earlier? It doesn't sound like it's so important that your average close is above your average, above your moving average. Well, this is important because once you are breaking above average, that means you have a lot of force. There's a lot of force here, a lot of force here, and enough force here to continue and break that high. So that's one way that you can trade a bullish consolidation zone. Again, just to recap is price action comes down, gets stuck between the moving averages. As it starts to dance around, you can simply look for a wick rejection. And I did that by looking for the low of the bullish and the high, the low of the bearish and the high of the bullish, right? So here's a low that gets a wick rejection of a 100 period. So that means in my push down, I cannot break the last 100, but in my push up, I can't break the last 50. So I'm going to draw a box from here to here and then just drag it out. Okay. If you get a new rejection, you don't necessarily have to change it, but you can, because this is basically telling you, here's your new low, right? You can do that if you like to. I'm not doing it because we clearly have breaks to the long side. I feel like just the highs are getting higher, but the lows are getting higher, but the highs are not getting higher. Like this is not happening, but this is happening. Okay. So if your lows are getting higher, but the highs are not, that means you're getting more support, more support, more support, more support. And it's just going to be breaking out the top. So stay tuned for video number 2 when we talk about this resistance zone and how important is this consolidation area that shows up later on. Just as a point of reference, it kind of looks like this. Bullish consolidation zone, why is this important? Leave it marked on your chart, take your trade and do what you need to do. But this area is important for later on. Like I said, what happens now dictates what happens in the future, right? So I'm going to move this to that resistance area, okay? And then this, I'm going to raise this to that last low that we had below the break, right there. See, that's that last low. But look what happens later on in price. What do we have here? For some reason, the price comes down and it has trouble breaking the mid-level of this, comes down, has trouble breaking the mid-level of this again. Now it sounds important, right? Okay, so that is a quick little setup for how to use moving averages in a comprehensive method. Stay tuned to the coffee shop. We got more stuff coming in just a little while. Peace out.